Hello and welcome to this webinar, CFA Level 1 Financial Reporting and Analysis. Now, um, I want to talk about every Wednesday, I want to talk about something important for your next CFA Level 1 exam. So what I did so far last hour was, what was it? Was corporate finance. It was about measures of leverage. Now we'll be dealing with long-lived assets. Long-lived assets, that is financial reporting and analysis, of course, and it's part of which reading? It is reading 26 in the 2020 curriculum. So if you're taking level 1 exam in December 2020, it is reading 26. Yes. Now, there's two things I uploaded so far. First of all, this is a mind map consisting of 5 pages, I think, and it's a mind map. So my way of learning and my way of telling others to learn is by communicating it via mind maps, because this is how the brain works. The brain does not work in in words, but it works with pictures. Your brain and my brain and everyone's brain works with pictures, and this is why it is better to memorize things that are important and that depict abstract things, to memorize them in terms of pictures. And this is like, it's not really a picture, but the I put those words in a structure that is similar to a tree, and therefore it is, as I say, as I call it, similar to a picture. And it's better to memorize. It's better to memorize because here, given the tree structure, it is a better way and an easier way to really learn this by heart, that you must learn, that you want to learn, and that you must learn. So now, financial reporting and analysis deals with, first of all, study session 6, then study session 7. And with study session 7, we have income statement and the balance sheet. And those are the two most important parts of the annual statements, because with the income statement, it's about expenses and revenues, so the components of success or failure. And with the balance sheet, it's about talking about assets. It's assets on the asset side, it's liabilities and equity on the right hand side of a balance sheet. And that's the important aspects. Like, we have three important aspects with financial reporting. First of all, cash flows, like everything that's happening with cash inflow or cash outflow. This is the cash flow statement of cash flows. Second, it's talking about assets. So assets and liabilities, the balance sheet. So the balance sheet tells us everything that a company owns, asset side, or that the company owes, liabilities and equity side, right? So this is the meaning of the balance sheet. And then the meaning of the income statement, it tells us the success, if any, if there is any success with the company. So revenues and expenses. And that's important because revenue and expenses and not costs. So try to evade the word costs with financial reporting, because we talk about expenses with the income statement, and not we're not talking about costs. That's really, really, really important. Really important. With corporate finance, I was dealing with corporate finance, and now we're go. Like, we were talking about costs, but this wasn't really an issue. Like, we could have said expenses instead of costs with corporate finance, but here with financial reporting, it's really important not to confound the words, not to change the words, and it's called expense when we're talking about the income statement. So now, and here I want to shed some light on long-lived assets. By the way, did I tell you already that I want to repeat those webinars each and every Wednesday? Free webinars, CFA Level 1, each and every Wednesday. I'm going to do some non-free webinars, I mean longer webinars, including everything webinars that are no longer free anymore, unfortunately. But I'm gonna do them later on, maybe in 4 or 8 weeks. I don't know. We'll see. But now, for now, in the next weeks, I'm gonna do some free webinars dealing with everything, dealing with all the 10 different topics of level one, of CFA level one, and that is ethical standards, ethical and professional standards, quantitative methods, financial reporting and analysis, economics, fixed income, equity, portfolio management, corporate finance, alternative investments, and derivatives. For the first time ever, I could tell them all in a row, the 10 topics. Normally, I just I don't remember normally the word. I think portfolio management. That's the one I forgot most of all. Now, and I'm planning, and I already planned the details. I'm planning on doing all 10 subjects, so everything that deals with CFA level 1. And I think maybe with level 2 just as well, because I love level 2 just as well. Now, long-lived assets. This is financial statement elements, first of all. So as I said, the balance sheet can be found here. The balance sheet tells us what does a company owe on the asset side, on the left-hand side of the balance sheet, and on the right-hand side, what did I say owe? Again, what does the company own on the left-hand side, on the asset side? What does a company own? And it owns the assets. And what does a company owe? And it owes liabilities to others, and it owes equity to not itself, but to equity holders, to shareholders of the company, so to the owners of the company, it owes something just as well. So what a company owns, asset side, and what the company owes, liabilities and equity side. And again, the income statement dealing with revenues and with expenses. And in the different videos, I'll shed some light on revenue recognition and expense recognition, but that's a different story for now. We'll be looking at something else. We'll be looking at long-lived assets. Oh my God, that's a good story. Reading 26. Reading 26. What is long-lived assets? Like we can look this up here in the description of the balance sheet. And that's part of, if you look at IFRS, International Financial Reporting Standards, it's about Standard 1, paragraph 54. So in Standard 1 and paragraph 54, it's always the structure of the balance sheet. And you can look this up exactly there. Exactly there, it's the structure of the balance sheet. So, yes, long-lived assets, which is property, plant, and equipment is part of it, not the other way around. So property, plant, and equipment is just a part of long-lived asset, but a very important one, a very important part of it. Long-lived assets. First of all, there's two really important questions that need to be answered. It's the question of recognition. Is something part of the balance sheet or not? Is an asset, can something be called an asset? And is it part of the balance sheet or is it not? If it's not, it's going to be expensed. It's going to be part of the income statement. So when answering the question on whether or not something is part of the balance sheet, we say yes or no. We say yes, so balance sheet, or we say no, then it's going to be expensed, then it's going to be part of the income statement. And if we say yes, if it's part of the balance sheet, so if the answer to recognition is yes, then we need to answer measurement, second question. That's the second big, not biggest, but the second big question. Measurement that can be decomposed into initial measurement and subsequent measurement. So initial measurement deals with costs, whereas subsequent measurement deals with measurement of the periods to come. So there is depreciation, there is amortization, and there is impairment, and maybe reversal of impairment. And that's what I was just trying to tell you now is really important. Long-lived assets. Long-lived assets. So it's first of all recognition, recognition, and then second, it's measurement. Measurement. Recognition, measurement. And recognition, again, deals with the question of whether or not putting something into the balance sheet. If it's not put into the balance sheet, it's going to be expensed. It's going to be part of the income statement. But if it is, it's going to be part of the balance sheet and will be expensed later on in the future as part of depreciation or amortization. So measurement is two things, is initial measurement, as well as subsequent measurement. Subsequent. I spelled it wrong here. Subsequent measurement. So if the answer to the first question is clearly yes, it's say we're dealing with property, with a property. Part of the asset side is put differently with the word capitalized. So it's if something is capitalized, it's going to be put onto the balance sheet on the asset size on the asset side. I'm sorry. Second, if the answer is yes, so if something is recognized as being as an asset, we have to deal with the second question of how to measure it initially at first sight on the first day. If we buy something, if we buy a machine, like we buy a machine and say the expenditure is going to be €1,000, we say the cost, which is the initial measurement, is going to be $1,000. So there's two accounts rising. First of all, machines being part of the balance sheet, and then, did I say rise? Sorry, the second account, cash, is going to decrease. It's going to be increased. So one asset account is rising, the other asset account is decreasing, machine is going to rise, cash is going to decrease. So all in all, there is no change. There is no change on the asset side whatsoever as the result. So like the two parts of it are going to change, but as a result, there is no change at all, nor on the asset side, and neither on the asset side nor on the total sum of the balance sheet. Mhm. That's the first thing to understand. Then there is subsequent measurement. Subsequent measurement deals with, first of all, depreciation and amortization, and I should better say depreciation or amortization. Depreciation or amortization, because the deal is this, like depreciation tells us something about tangible assets. If you can touch the asset, if we're talking about a machine, a computer, something like this, it's a tangible asset. And a tangible asset, the cost of a tangible asset are going to be expensed over the useful life of the machine and are going to be depreciated. Whereas talking about an intangible asset, this is going to be, the costs of them are going to be amortized, not depreciated, but amortized. And this is something that can be found here. Tangible assets, so acquisition, tangible and intangible assets. And yes, yeah, we have purchase, initial expenditure, and subsequent expenditure, and it's going to be capitalized. Something is going to be capitalized if they're expected to provide benefits beyond 1 year in the future, then it's going to be capitalized, so part of the balance sheet here, or it's going to be expensed. The expenditure is going to be expensed if It's not expected to provide benefits beyond 1 year in the future. That's the important thing about this. So, the one or the other. This is the initial decision of whether to capitalize or to expense something. If we buy something for $1,000, if we buy a machine and the machine is delivered to our factory, are we gonna capitalize it? Are we gonna put this machine onto the balance sheet, or are we gonna put it into the income statement as an expense, not as revenue, but as an expense? And the answer is yes, we're gonna capitalize it because the machine is something that comes with a benefit that lies way into the future. In the next 3 or 4 or 5 years, there's benefit um, that come together, and therefore it has to be capitalized and not expensed. So this is the initial decision that's truly that's truly pivotal to the future life. Because if it is capitalized now, it needs to be expensed later. And if it's expensed now, there is no expensing later and no capitalization later. So the initial decision really has a large impact on the future, not decisions, but on the future ways of coping with this problem, of this challenge. Um, yeah, that was so the tangible assets deal with depreciation, whereas the intangible ones deal with amortization, which is the same. Like, I mean, we compute it the same way, exactly the same way, but the words are just different. One depreciation and one is amortization. This is it. And this is repeated here with measurement, initial measurement, so in initial period, capitalization or expensing, and a subsequent measurement, the writing down of long-lived assets. So the writing down means depreciation or amortization, dependent on tangible or non-tangible, intangible. So depreciation and amortization is because we want to allocate the cost to the future periods. That's all it has to do. All it's all about. Like, again, when we want to allocate costs of now into the future, we're talking about depreciation and amortization. This is the use of it. Whereas with impairment, it's a totally different story. With impairment, it's about the catastrophe itself. Like, there's a fire, there's a factory burning, completely burning down, and that's when and why something needs to be impaired. So impairment does not occur in order to allocate costs to the future, but in order to cover in order to cover a catastrophe coming like a fire coming to the factory and burning down the factory entirely or partly. So that is depreciation and amortization for, and then we have impairment, and then we have impairment. That's it. Now, first of all, as you see, I'm working on with this mind map. That's part of my yeah, that's a part of my mind maps here. So mind maps CFA level 1 with for every aspect of CFA level 1 exam. But here, this is the first thing. The second thing I was going to show you, is this. I uploaded another document for today, April 22nd, 2020, and next come here again on April 29th, next week. So next week, on next Wednesday at 5 o'clock Central European time. I hope Central European time is okay for you. I mean, you can always watch the video afterwards, so you don't have to be like if you're from Australia, you really don't have to be here at 6 o'clock in the morning. I think at 6 o'clock in the morning there's better things to do. Although if you can't sleep, why not? Now, what was I gonna say? Questions. If tangible assets are impaired, this affects the income statement only, the balance sheet only, the income statement and the balance sheet. So tangible assets like a plant, like a factory, if there's a fire burning down the factory, what happens? How can we cover this event, this tragic event? How can we cover this event in financial reporting? And the answer is the account dealing with plants is decreased by this by the amount of money being lost here or by the carrying value being lost. And the second thing is that we have an impairment expense. It's an expense, and it's an expense because of impairment. So there is impairment loss, and there is that goes up. There is a larger impairment loss, and there is a smaller amount of, say, machinery, if it's a machine, or say plant, or whatever. So, all in all, it affects this fire will affect the income statement as well as the balance sheet. So, question one affects, or the answer to question one is C. I believe it's an easy question, but I found this question in the practice problems area, so I think it's not too easy. I would have said if I hadn't seen insight into the book, I would have said yes, it's too easy, but maybe not. Maybe this question is not too easy for your next CFA Level 1 exam. You'll see. You'll see in December 2020 or June 21, whenever you're going to take next CFA exam. I hope there is a December 2020 exam. I mean, June 2020 exam was cancelled already or was postponed or maybe cancelled, we should better say. So now, um, the revaluation model, I still didn't talk about this, but here, let's talk about question 3. Expenditures necessary to get an asset ready for its intended use. Because the actually the thing is, if we are talking about measurements, if we're talking about initial measurement, so we have to incur $1,000 of costs. Like we pay $900 and we pay for getting a machine, but we pay another $100 in order to get the machine to its intended use. To get the machine to its intended use. And this is why we also have to capitalize this amount of money. So 900 euros plus 100 euros equal 1,000 euros, and the initial cost of this machine, therefore, is 900 plus 100, so it's 1,000. So the cost of getting a machine to its intended use is part of the initial cost of a machine or of anything, of any given asset. That's really vital. That's really vital. So question 3, expenditures necessary to get an asset ready for its intended use are reported on the income statement only. No, they are reported first of all on the balance sheet. So this account dealing with machines, if it's about a machine, rises. So like we would say machine rises and cash goes down, cash comes down. So at first sight, it affects the balance sheet only. So answer B looks much more convenient, looks much better than answer A does. Answer A is wrong. It does not only affect the income statement, but Answer B seems quite all right, but it's not. Because, like, expenditures, first of all, in the initial period, initially are reported on the balance sheet only. But then in the future, I mean, what is the task? What was the object of depreciation? The thing with depreciation was to allocate expense initially, the initial expense, to allocate this initial expense to the future with depreciation expense. And therefore, in the future, it touches the income statement, whereas now it's part of the balance sheet. So this was a tricky question, and I invented this question. So I was thinking to myself, how can I really lead those CFA candidates into the wrong direction? I would have thought, I might have thought like most CFA candidates would have guessed B is right, but C is right. First of all, it's reported on the balance sheet, but then in the future, it is allocated and expensed on the income statement as being part of depreciation expense. That's a good one, isn't it? That's a good one. I'm so proud of it. Now, that was question three. Oh yeah, oh my God. Question four is a difficult one, but we're going to talk about this later. So, question four is too difficult right now, as well as question two. So, we need to go back to the mind map section: measurement, initial measurement, and subsequent measurement, as I told you. Again, for all of those who switched in, who join in now only, we are dealing with long-lived assets. We are dealing with reading 26 CFA level 1 2020 curriculum. It's going to change maybe in next year, 20. What was I going to say? Yes, there's something, there's something that is important, and this is the revaluation model. This is the revaluation model. Let's look at this. Like, initial costs of a machine have amounted to 1,000 euros, or $1,000, whatever, or 1,000 Swiss francs, whatever. But including the costs necessary to get the machine, to get the asset to its intended use. But let's say fair value, like 2 years later, the carrying value, so the useful life, shall be 10 years. 10 years useful life. And it's going to be depreciated with $100 each and every year, right? So that the carrying value 2 years from now shall be 800. But what happens if the fair value, if it's about land, let's say it's about land and there is no useful life. Useful life equals infinity, infinity. So there is none. What happens then? If there is no depreciation, so the carrying value will always be 1,000, unless fair value is going to rise. What if fair value is going to say 1,200? Then we should say that the revaluation surplus amounts to 200 euros, and the asset is going to increase by 200 euros just as well. So that's what we're going to do 2 years from now. We are going to increase the asset, and we're going to, so the asset side, the left-hand side of the balance sheet, is going to be increased by 200, but the right-hand side, liabilities and equity side, is going to be increased just as well. So the revaluation surplus, which is part of equity, is going to go up by 200 euros just as well. So all in all, the entire balance sheet is going to increase by 200 euros. And that's called revaluation surplus. Revaluation surplus. If it goes down afterwards, then revaluation surplus is going to shrink. And if it goes down under 1,000, we are going to report it on the income statement and not on the balance sheet. And that's why, are we are we ready or already to answer question 2? Which of the following statements best reflects the truth about the revaluation model? Under the revaluation model, an asset's revaluation is reported always on the income statement, sometimes on the income statement, or sometimes on the balance sheet. Yeah, what would you say? Try to stop the video now if you're watching this video in the future. Today is April 22nd, and if you're watching this video, I don't know when, somewhere in the future. I hope when coronavirus episode is going to be over. Maybe you won't understand the word. What I hope you'll do, but right now we have the coronavirus episode of our lifetime. Question 2. So the revaluation surplus effects under the revaluation model, an asset's revaluation is reported on the balance sheet, as I said, if it goes up. But if it comes down, and if it comes down underneath historical cost, it's reported on the income statement just as well. On the income statement just as well. Therefore, it's not true to say A, always on the income statement. It's not true to say sometimes on the balance sheet, because it happens always on the balance sheet. Like it's always something that deals with the balance sheet. Since the fair value goes up or the fair value goes down, so does the carrying amount of the asset. The carrying amount of the asset goes up or down. So balance sheet is always affected by revaluation surplus. So it's true to say answer B is correct. 2 is B because it's reported sometimes on the income statement. And it's reported on the income statement if the fair value goes beyond the historical cost, sinks underneath the historical costs, and therefore the income statement is affected. So the true answer of question 2 is B. And coming to question 4. Oh my God, question 4. We have to talk about impairment. We have to talk about impairment expense. And this is this. And please get your calculator, get your handheld computer. Impairment, confer next page because it's something larger. It's a larger thing to see. So if the factory is gonna burn down, it's a catastrophe, so it's not about allocating expenditure to the future as expenses, as depreciation or amortization expense, but it's about reporting a catastrophe here on the income statement as an impairment expense. But to what amount? How do we compute? How do we calculate impairment expense? And the answers can be found here. Property, plant, and equipment. And it is this. The higher we compare the carrying amount, which would have been true if there hadn't been any impairment event, there would have been only the carrying amount, so historical costs minus depreciation or amortization. But then we have to compare. We have to conduct an impairment test, and we have to compare carrying amount to the recoverable amount. And the recoverable amount is the higher of And now that's important, and that's the last thing we'll be talking about today. Recoverable amount. Recoverable amount is the maximum value, is the higher of fair value less cost to sell, less cost to sell, of the future cash flows. And there is a certain given name for this. It is called the value in use. Second value we need to consider is the value in use, which actually is the present value of future cash flows. Therefore, the higher of those two values is the recoverable amount. And if recoverable amount is strictly inferior to carrying amount, we need to say yes, there is an impairment, and we have to impair the machine and change the recoverable amount to the new carrying amount and get a new plan for depreciation and amortization. Next to 2000 minus cost to sell. So 2000 minus 800. And we compare this value to the value in use, which is the sum of discounted cash flows. So market discount rate equals 10%, and there are three future cash flows, 500 each and every year, which amounts to 500 divided by 1.1 plus 500 divided by 1.1 squared. And yes, it's 500 divided by 1.1 to the power of 3. So the higher of 1,200. And what is this? 500 divided by 1.1 plus 500 divided by 1.21, which is 1.1 squared, plus 500 divided by 1.1 to the power of 3, equal to this amount of money, 1,200 something, 1,243 times 43. So the higher of those two values equals $1,243.43. If it's dollars, maybe it's euros, I forgot. But that's not the most important question. So the recoverable amount is this. What would have been the normal carrying amount if there hadn't been any impairment event? An asset is purchased for 1,500 in the beginning of 2019. And then the new information is given 2 years later, actually. It's 1 year later at the end of 2019 and 2 years later in the end of 2020. So 2 years did pass already. What's the useful life? The useful life is 10 years, isn't it? It's 10 years. So there is, what's the cost? The cost purchased, blah, 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 with respect to future cash flows, cost to sell, fair value if sold, blum, 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 blum. Oh yeah, 1,500. 1,500 is historical cost. So historical cost divided by 10 equals 150. So 150 times 2 amounts to 300. So 1,500 minus 300 gives us 1,200. So the normal carrying amount is equal to 1,200. So we need to compare this to 1,243, which is this. This means if the recoverable amount is inferior to the carrying amount, we need to have an impairment. And if it's not, we don't. If it's not, we don't need to have an impairment. So there is no impairment if the recoverable amount is larger than the carrying amount, which is true in this case because it should normally be at 1,200. It is 1,200 and something, which is larger. So there is no need to have an impairment here. So the answer to this question, to my mind, is C. No impairment expense needs to be recorded because the carrying amount is not larger than the um, recoverable amount. That's it. So, if you have any questions to this, don't hesitate to ask in the next webinars. Next week it's going to be equity, I think. And what's the next? I think I did put them already onto my Facebook Facebook profile. So look it up either on my home website, danielmeinslambert.de, Germany, and or you look it up on Facebook on Lambert Education, which is my Facebook profile dealing with CFA level 1 content and level 2 content. That's it for now. See you again next week at 5 or next week at 6. Each and every Wednesday, I'm going to do some webinars, live webinars. You can actually participate. And when I say live, I mean live. Like you can participate, you can ask questions, ask clarifying questions, need to answer my questions, and need to follow everything that's important for CFA level 1. Thank you for watching. Thank you for being here.